how are you penciling in 2026? There's an earnings cycle revival, at least that's what most analysts seem to be penciling in. How are you viewing 2026, and what are those pockets that you're liking at this point?
Hi, Harsh.
Hi.
Thanks for having me here today. I think, we are in still the middle of the moderation that perhaps started about 15 months or 16 months back. So as we enter the new calendar year, I think we're just in the middle of the cycle of the large caps versus the mid caps and the small cap outperformance. So I would say I would look at another 10 to 12 months in a market where large caps continue to go sideways or perhaps lose less money as compared to the mid caps and the small caps. And no reason for that to change, which I had shared earlier as well. So, though the markets are at seriously high levels at about 25,900, 2600 all-time highs, but that's only because of the few large caps performing and the few mega caps performing. So that's my view going into the new year. However, I can take your question on the earnings as well. Or would you have another question?
No, sure. No, Nitin, give us a sense. Do you believe earnings have the potential to surprise on the upside at all?
So, when we look at the second quarter September numbers, definitely, and if you look at the consumption numbers that came out, it was a reason to cheer and optimism that the earnings are turning around. Because this year was a year of very weak, muted earnings, and the small cap and the mid cap earnings are looking even bleak outlook. I think that's changed a little bit because of the consumption, but I would also maintain that at the same point in time, no trends in India are giving you a definitive confidence that the trend is accelerating or it's catching momentum towards one direction. We've seen post the festival, the GST numbers not looking very good either because of inflation or the consumption has actually become weaker after that. So hence, when we look at most of India's mid-cap companies, I would be a little bit careful about the consumption-based earnings for the mid-caps, especially around discretionary. I would say I would not be that much worried about the earnings from companies like an FMCG. So I see that there is going to be a moderation in the FY27 earnings estimates, but I don't see that to be very, very acute. Perhaps settling closer to about 10 to 12% for Nifty and slight more moderation for the mid cap and the small cap. I think the earnings risk still remains to our estimates, but it won't be as bad as what was FY26 in terms of earnings.
Okay, interesting. And Nitin, sectors, pockets that you are finding could be good opportunities to play maybe over the next 1 to 2 years, which could lead the revival likely in terms of earnings and where risk reward looks good?
I think last time when I had presented, my view was a little bit non-consensus on IT at that time. We said that when the market goes into this moderation phase of fragmentation versus concentration, IT tends to outperform. 3 months back, IT in India was not an under-owned sector. Today, it has become an overweight amongst most of the mutual funds. We still maintain our 3 top sectors as IT, FMCG, pharma, including healthcare. I think those are the ones I will still continue to say so, but at least for the near 3 months to 6 months. When it comes to 1 year, I would suggest that one should be looking at more stocks where companies are actually allocating capital for not only building their revenue base from India, but also for a revenue base from outside India. So these days, I would say the mid-cap companies and the smaller cap companies which are looking at, let's say, scaling up and playing world as a market, only compared to relatively to domestic consumptions, I would prefer the former companies building for the world as a market. So that is a theme, I would say. Going into the budget, I would say, there will be a lot of talk or chatter, I think, about MSME in the next 1 year, because MSMEs being the backbone of India right now seem to be driving formalization of everything, of even employment. The recent changed labor codes should help MSMEs become slightly bigger. So I would say even NBFCs or regional banks looking towards MSME credit, I would prefer them as a mid-cap or a small cap cohort over the next 1 to 2 years. Those two themes stand out in my mind
And what about IT, Nitin? There is one take which says that, of course, rate cuts in the US will largely aid IT. There's a decent probability of that playing out as well. Now, 25 bips is what is being built in for the whole of 2026. Firstly, give me your take with regard to whether you believe that that is realistic, given that there will be a new Fed chair coming in and who will likely be much more dovish than the current Fed chair, and what that does to IT as a whole and a possible revival.
I'll not go into the US macro, but at the same
Sure.
point in that, we also pick that the US market is perhaps, economy is perhaps not in the best situation when it comes to their over reliance only on the AI right now, but there could be issues around jobs or consumption or housing. So hence, staying away from that, what we had also highlighted is when we see that the US CEO confidence is at nadir, very low points, from there on, the next 6 months or 12 months start looking very good for IT in the last 15, 20 years of history. Perhaps that's playing out. Weak CEO confidence index being a contra indicator. And so hence IT, we look from multiple points at how and where the earnings estimates will come down. I don't see material earnings estimates revisions downwards for the whole sector. And that was the reason that we highlighted about 4, 5 months back that one should start building in overweight positions on Indian IT companies at that time. So there are pockets of the internet, IT, one or two small caps or mid caps, which look good. But as an overall for the larger institutional investors, I would say it should be an overweight continuing for the next 3 to 6 months.
Nitin, I'm just wondering, as we step into the new year, how much of the story is going to be more bottom up as what's perhaps playing out in IT also, or vis-a-vis strong getting stronger?
I think, as I said in the beginning, we're in the middle of this cycle where the market actually goes through a tug of war of fragmentation versus concentration. Look at the small caps and the mid caps in India. Earnings growth, we are all getting cheered up at about 14-15%. Trailing 12-month earnings multiple is about 38 to 40 times. It's not a very attractive valuation point as a cohort to start with, but doesn't mean that every small cap or mid cap wouldn't perform. I would maintain, hence, as you rightly said, bottom up stock pickings ideas will remain the job for portfolio managers. And not only that, I think for them, it is also the sizing of the bets. We've seen that institutional investors who invested in the mega cap companies with reasonable exposure, whether it was IT or whether it was telecom or whether it was oil and gas also, OMCs or Reliance in the last 1 year, they've stood out in terms of performance. So I would maintain the next 12 months, if not 12, at least 9 to 10 months, will be a stock pickers market. Again, large caps losing you less money over the small cap and the mid cap. And within the IT also, companies where there is a reason for earning estimate revisions to be less. So we prefer companies like Infosys over there. We prefer companies like TechM over there. We prefer companies, on the similar lines, one or two more. So again, not the whole pack, but 3 or 4 selective companies to be overweight within the sector.
Understood. Nitin, the other thing is, the MSME expansion that you talked about, and one can see that in the government's thrust as well. What sectors do you play this theme by? Because there would be, many beneficiaries and sort of a multiplier effect, if you will.
So, as I said that, one of the biggest proxies is that as the MSMEs can now hire more people, perhaps the government gives them more support. Credit appears to be the first proxy where the regional banks and even the NBFCs can actually lend to these MSMEs as they go out and either build a better marketplace for themselves, either for selling or in India or outside India, etc. So I think credit MSME lenders will start looking better. That's one. I would say that could also mean that if they go out and hire people, there could be certain jobs dependent companies, whether it helps Naukri, which is Info Edge, and you can see that how they're hiring from the non-IT sector is also looking up over there. So Info Edge, Naukri business is a direct beneficiary of that. So those two things they come to my mind right now. Because apart from that, even you could say on the consumption, not I would say the top end consumption, but value consumption plays, though they are all very expensive in terms of valuations, and we may be carrying sales on a few of them, but the value consumption plays also start looking attractive but that's more like 2 years out. But in the near term, I would say next 1 year to 1.5 year, it helps MSME lending companies and companies like Naukri.
So do you tactically make that, or rather structurally make that shift out of premiumization into the more bottom-up consumption at all, Nitin? Or should it be a balance of both in one's portfolio?
I think again, portfolios have to be thought through from the size of money that the portfolio manager are handling. So hence, I would say many of these value plays, barring D-Mart or Vishal Mega Mart, are fairly smaller or illiquid, and the larger liquid names like Trends and the others tighten. So I would say you're right. One has to figure out which makes sense, but I wouldn't disagree with your point that a balance of one or two good premium plays and a balance of one or two good value plays. But again, FMCG, I would be a little overweight on the staples versus the discretionary consumption for the next 1 year.
You think the downgrades are now behind us when it comes to FMCG or discretionary in particular?
I don't think so for discretionary. I think discretionary, we've recently seen also that we had to cut our numbers. Not only that, even the urban dependent consumption, we had to cut our numbers in certain discretionary, even value plays. So I would say FMCG, yes, the risk of earnings appears to be materially lesser than the discretionary names.
Nitin, last when we spoke with you in July, you were of the opinion that you were not quite in favor of the defense theme. Has that view changed now?
I would disappoint myself by saying no. Actually, it remains the same. It remains the same. I think these are very promising themes: EMS, renewables, as well as defense, because we are trying to make ourselves manufactured in India for India and gradually for the world. But I would say today the valuations for many of these companies need to be thought through. That many of them are dependent upon the government. We know so many PLI schemes, so many closures of land acquisition, pace of order fulfillment hasn't actually caught up with the pace that investors or companies would have thought about, and that's why we are seeing that very recently the government bringing in a fresh way of attracting competition for certain monopoly defense companies. And if that is happening, which shows you that they are also thinking that we need to reduce our dependence upon one or two or three companies in a particular sector of government PSUs, whether it is, let's say, defense, aviation, or even for that matter, electronics.
Understood. Okay, Nitin, great having you on the show today. Thank you so much for your time.
Thanks for having me. Thank you.